good. You
Yeah.
know, we got it. We're being live streamed. So here we go. Zoom says we are live. So we are live. Facebook is still thinking about it. So we will share as soon as we can. And here we go. Bam. Greetings, everybody. Welcome to a very special Facebook Live of Private Lender Podcast. I'm your host Keith Baker, and I'm the host with the most. No, that's a really bad one. I'm sorry. I will. I'll take that one back. I take that one back. So anyhow, I am excited. It is now 7:31. I've got two lovely ladies here that are going to help just drop tons of knowledge on the topic of multifamily investing. As you know, fans and friends of the show know that for the most part, I talk about private lending to single family investments. However, in my private life, I've been doing some multifamily and some commercial investing. And so I don't teach what I don't know. So I bring people on who do, and they can talk about what it is they do and their processes. So first, I would like to introduce Lauren and Jennifer. Welcome, guys. Thank you for coming on today. And
Thank you for having us on.
absolutely, I'm looking forward to this. This is we're live without a net, so I know Jen, you don't want to upset your church folks with
I
the f bombs.
know.
We've all
And dirty
promised
jokes.
dirty jokes, no
But
dirty
all my
jokes,
friends that are on, they know. They get it.
and only in a 2 drink maximum during the Facebook Live. That's there's the one. Oh, good for you. I'm so jealous. I'll have to. The kids aren't home. I can't have them pour me a drink. So anyway, well, all right. So I'm babbling now. So let me get straight to you guys. Let me start with Lauren. Please introduce yourself. Tell us sort of your background in real estate, how you ended up on this show. Basically, how sort of walk us through real quick, and then we'll have Jen do the same thing.
Hey guys, I'm Lauren. I actually am a single mother. My daughter's turning 8 on Halloween. She's been my driving force to get me into real estate investing, actually. My journey started back in 2018-ish. Started with a hard money lender, slowly turned into wholesaling on my own, and now transitioning into multifamily with Jen. So also, I have my own coaching business, the Subconscious Muse. I help people essentially navigate their limiting beliefs that stem from their traumas and help them live fully in the moment and create the lives of their dreams. So, just very passionate about helping others and also just showing the world how easy it is to just pursue what you want and help create the life that you desire.
And I for one can speak to your services. I was a client, and yeah, one of the best coaching decisions I ever made was to hire Lauren. And it's amazing that just what you know, but you don't admit that you know, and it's some hurdles. Yeah, definitely some hurdles. Still working through it, but definitely a worthwhile endeavor to go back, and it's not always pleasant, but there's definitely light at the end of the tunnel, for sure. And I want to thank you for helping me and get to this point. The past couple of years have been less than ideal, but here we are, still going, still trucking. And and that's how sort of met Lauren, and her partner here, or her coworker, colleague. I don't know exactly how you guys want to say it, but I didn't hear that. I'm sorry. What was that?
No, we're absolutely partners.
Partners. Okay.
Yeah. So I have to, like, Lauren coaches me and I have to coach them too. I'm like, you're not my employees, like, you're partners. Like, we're all in this together. Like, we own all of this together. One of the things I love most about my business is the team that I'm surrounded by. And Lauren is, a super wonderful key factor in that. And, we have a meeting every Monday and she comes in with her insightfulness and, just gets us over our hurdles, gets us out of our heads. We have a couple Pisces on our team. So that's like super problematic. And she's right there to like steer the boat and keep us on track. And yeah, she's amazing. So if you don't have a good like life coach or get out of your head coach, I definitely, Lauren's your go-to for sure.
Y'all are awesome too. I'm so happy I stumbled across both of y'all's paths. Thank you for your kind words.
Oh, no, thank you. It's helped me tremendously. So, okay, so Jen, tell us how did you end up on this show? where did you
So,
where did you go
you know,
wrong to end up
look,
on this
right,
Facebook
my
Live with me?
path is so crazy divine. Like I just attract the best of the best. And not to say that with a prideful intent, but I mean, I when we got into real estate, and I was not happy about it. This was not my decision. This is nothing that I wanted to do. I was kind of drug into it by my husband and my son, and really blindsided by it. But I said, like, if we're truly going to do this, we're going to surround ourselves with the best in the business. And I didn't even know what that meant when I said it. And just by, God's grace, here we are, 3 years later, and true to what I put out in the universe, which I didn't even know anything about, speaking and getting what you receive, and getting back from the universe what you speak. I didn't even know anything about that when I said it. But I watch it happen all the time. And we truly are, best friends with some of the best in the business, and hence, Keith, you get to be in that category. And so here we are, and I'm basically, just trying to, keep connected. When we went from single family to multifamily, we just kind of transitioned into kind of who we hung out with, who our friends were. It's kind of a different space. And so, we're just plug in where we can plug, and thank you for having us on again. And
well, for a couple of things, met both you guys at the Heroes Coaches Summit back in April in Key West,
right.
which was for me personally it was one of those. I got on the plane, I didn't want to go. I was thinking about how can I got too much going on. I don't have time to take 3 days and talk coaching or real estate or funnels or anything like that. And it ended up being one of the best trips I've ever taken in my life. And I got to meet you guys there and start chatting and sort of what's that?
Divine path.
Yeah. So and here we are in August, 4 months, almost 5 months later, and like I said, recently I've started dabbling as a private lender into the multifamily commercial space outside of single family. But if we can, I'd like you to sort of talk us through how, whether it be the light bulb moment or, this is the way one of my mentors, Stephen Kaufman, put it, was just, you're talking about a $300,000 home and you're going to buy it and fix it up for 70% LTV or whatever, commercial property or, in some, smaller apartment complexes, just add a zero. You're doing the same amount of due diligence. You're doing the same amount of work, underwriting it, but you just add it, or two sometimes. It just depends on
Sure.
Whatever. But let's sort of walk us through the transition from single family into multifamily, because I think a lot of people believe that, I can own a house, I have a house. Single family is easy. I utilize it, whereas a lot of folks don't own, or maybe don't live in an apartment complex or are buying one. So, how does that look? That transition look, or how did it look for you? I should say.
Well, for us.
Oh, I'm sorry. I just realized I'm not recording. I'm sorry. So. Yeah. I'm sorry. Here we go. All right. So same question, but now that we have a record of it, yeah. Please tell us about your transition.
So my transition for myself was, of course, we were in single family. That's about where I think it's pretty safe to say like 98% of us start in single family, because, the multifamily is intimidating when you don't know. I mean, you look at 300 door complex and you think that's impossible. Like, who does that? Like the Donald Trumps, and in reality, you're right. It's just a couple zeros and doors. So instead of hustling and grinding for 50 doors a year or a month, whatever, however people are scaled, and I get it, they make millions doing it, but their funnel always has to be primed, right? They're always grinding for their next deal. Where in multifamily, you do 2 or 3 and you're done, and what you're really just priming and keeping your funnel is the investor part. So for us, again, we started single family. We went to a multifamily meeting that I was personally invited to. And I said, this isn't my thing. I'm not an accredited investor. And she said the most profound thing to me. And she said, you never will be either of those if you don't go to this training. And so I did, and realized that this is where we were supposed to be. The numbers, the spreadsheet. So my husband, who hardly anybody ever sees, I am married. His name is Eric Falloon. Someday he'll be in the space more than he is, but he's a CPA and totally geeks out on numbers and spreadsheets and all the stuff, due diligence. And I thought, this is where we're supposed to be. And when we started, the end goal was to get him retired early so we could, of course, live the life of our dreams. We wanted to live on mailbox money. And this to us was the fast track. So I went to the boardroom without him. Of course, he never gets to go to anything, or rarely does. And I was so blown away that I said, I'll pay for another ticket. We have to go again. And so we actually canceled a vacation that we had planned for Jamaica to go to Phoenix, Arizona, and to this training. And we were sold. So we joined the mastermind, which, if you're not in the mastermind, I totally, recommend you be in one, for the accountability and the support and the learning. And then we just started partnering on deals and, learning how to drive the bus and learning due diligence and learning how to conservatively underwrite. And now here we are, 2 years later, and, thousands of doors, and, and more is coming.
All right, but there's a few things that you said I'd like to unpack, and the first one being an accredited investor, just in case there's some folks listening that don't understand what that is. I'd like to hear your explanation in your words of what an accredited investor is.
So there's two types of investors: accredited and non-accredited. And it's basically about, like, what do you have in your assets? So an accredited investor, you have $1 million in assets, not including your homestead. I think it's like $250,000 liquid. So there's a criteria of, and don't quote me on that because I'm not, without the cheat sheet, I don't really know. And I think it just changed. So, but
it changes frequently. Yeah.
Right. But the main gist is, how much money do you have in assets? You have to have X amount in assets and X amount liquid to be accredited. And you have to have had real estate investing experience. Whereas non-accredited, you might not be completely liquid. You might not have as many assets, and you might be kind of new to real estate. You kind of know about it, but you don't have the experience to be an accredited investor. And I think to be accredited, I think it's like 2 years experience. So not to say, and there's two types too. There's a 506B and a 506C, where if you're buying apartments, you can only have accredited, or in our case, we accept accredited and non-accredited investors. So we want everybody to play. We want to give everybody the opportunity to wealth build and earn passive, consistent income. So we do both accredited and non-accredited.
Excellent. And also, if you, I believe it's if you're single and you make $200,000 a year in income, or married, $300,000 combined, in addition to your $1 million net worth, minus your homestead or the house that you live in. So you take that away, you got to have $1 million, or make $200,000 a year, $300,000 as a married couple. And there's also, and this is for the SEC, the Security and Exchange Commission. They're the ones that you got to stay compliant with, and so that's why accredited always comes up. And if you allow non-accredited, correct me if I'm wrong, but if you allow non-accredited investors, which I'm glad that you do, because that democratizes the investment for more people. But you can't advertise. You can't go out and say, "Hey, we're buying this apartment complex. Talk to me about jumping in." If you're only taking accredited, then you can green sheet, Facebook ads, or whatever, right?
Yeah, all of it. So yeah, we don't advertise any of our deals. And we just encourage anybody that if you think you might be interested in the future to go on our website, fill out an accreditation form. I don't even think I'm supposed to say that, but when we're having one-on-ones, we want them to fill out the accreditation form so we can prove we have a substantial relationship before we bring them in on any of our deals. So yeah, so we're very scrutinized, and we do our best to follow the rules, which I've been hit a couple times for saying stuff I shouldn't. So I basically, when I'm talking about anything, it's is it education or am I soliciting? So I'm always educating, never soliciting.
I have a question from Facebook that I would like to bring to the table.
Yeah.
We have a Rita Monroe. Her question is, are there good investors for non-accredited investors, or do we need to get the leftovers?
So I'm sorry, repeat it.
Rita Monroe said, are there good investments for non-accredited investors, or do we get the leftovers?
No, she get the leftovers, please. No, absolutely not. You get to be front and center and the best of the deals. And
all the things.
Yeah. And here's the thing with our deals is we go through every deal with, the Hubble telescope. Like, we are doing forensic analysis on our deals, and they're very underwritten, or they're underwritten very conservatively. So, it might not look like, it's like, oh, we're going to get a couple $1 million, which, when you're talking, 200-300 doors may not seem like a lot, but we underwrite in such a way that we're not losing. And then whatever we exaggerated on, we're going to make up on the back end anyway. So that's just more, benefit for us. But if something should go wrong, we're covered. So we would rather make it up in the back end than ever come up short. And if it doesn't cash flow and it doesn't go through our multi-level scrutiny, then we just don't do it. We move on, let somebody else take it. But no, if you're a non-accredited investor, you get the same benefits as the accredited. You get the same opportunities as the accredited.
Yeah.
Excellent. That's why I like the model you guys use is for many years I was on the outside looking in, right? Okay, so I gotta go get $1 million. I gotta make 200 a year, or whatever. And so the fact that and that's one of the beautiful things about the internet, I think, is educating these folks that this is available to your Main Street investor, right? I mean, for me, when I was, in my cubicle, wanting to invest in real estate, and I thought, these types of deals were not, available to me because I wasn't accredited. And lo and behold, yeah, it all depends on how you, the operator, are going to set it up. And the fact that you take non-accredited as well. Thank you for that. And anyone who invests non-accredited, unaccredited folks should, I think, like you said, I said that you're democratizing the investments for everybody. So, and everybody gets a piece of the pie, or is able to.
So I'm glad I wasn't super off on the accredited investors. So I kind of did know what I was talking about. I should have just been like super confident about it. But
well, it's just that. I mean, it's the SEC. It's all about being compliant, but then it's, and this is not to get political, but it also depends on the administration and the climate. Like
there's regulations. It's hard to top up unless you have an alert on your phone every 5 minutes. So understood.
Yeah.
I did want to add to that as well, and also state that perception of multifamily is pretty much what you were saying. It seems like it's one of those like golden children that you can't touch. It's too high to reach. And when you first start, you're like, what is this thing? I don't have $1 million. I guess I can't partake. And then the people that talk about it, or at least the perception of it, when I first started, it was very untouchable. It's going to take you a while to get there. You're going to have to work really, really hard to get there. And then what I found out, once, like Jen mentioned, you just surround yourself with people who have the right mindset and can help you see beyond those limited beliefs that a lot of people really do have about it. You realize it's not that challenging. You just need to find the winning team, the people who see the bigger picture, the ones who want to do it the right way, the ones who aren't after their own pocketbooks, they're after their passive investors benefiting from it greatly, which is targeted underwriting and on whatever is going to make them an extra buck or penny, whatever it is. So I just wanted to give my extra 2 cents there.
Thank you.
All right. So, so you got the non-accredited. Yeah, no, non-accredited don't get the leftovers. No, that's in some funds and deals perhaps, but not with you guys, right? So, so going back into the you saw it as a fast track, and let's talk about how you underwrite a deal. Let's start from scratch, right? So, for the single family world, let's say I'm used to bandit signs, not in the city limits, but just or a mailing list, postcard, yellow letter, whatever. Mm-hmm. How does walk us through your typical multifamily deal? Nothing specific. This is not an offer or solicitation. No. Just to get that clear. But you can walk us through what you've done in the past, and so I'd like to know how does that deal look as far as putting it together, closing, operating the deal, and then also I'm very keen on underwriting. And my everyone is a fan of the show knows there are 2 ROIs. Number one is the return of investment. That's the first most important one. So if I'm lending $1,000, $100,000, doesn't matter. I want to make sure I get that money back. Second ROI is that return on the investment that I've made after I've gotten my money back. So if you can just walk us, from you're looking in the back of the green sheet, LoopNet. Let us. How's it look?
Yeah. So step one, you have to have broker relations. Without a good broker, it's your deals are going to be really hard to find if you're cold calling or using Reonomy. And they know the lingo, right? Like they know the backdoor lingo to get to the sellers, or they have a list of themselves. And so they're giving you the list before they shoot it out to the public. So having a good broker is like everything. Cause it's kind of like getting the secret treasures before anybody else. And if you act on it, nobody else in like the world, or the MLS people or other realtors, they don't even know that complex existed. And we are so blessed with our broker because he actually pre-underwrites our deals. So he knows exactly what my criteria is. And before he bothers me with it, he's going to do a preliminary underwriting to make sure it fits our buy box. Then I get it. And I have brought on an amazing underwriter who does all of our underwriting. Brought him on. He does it full time. He's underwriting, 4, 5, 6 deals at a time. And so it's super conservative. It's, again, the forensic analysis. We're calling city municipalities, finding out taxes. We're doing CMAs, the same as you would any kind of single family. Like, what's the occupancy? What are the rents? Is it cash flowing? What kind of neighborhood is it in? Is it safe? Do people want to live there? And of course, we look for apartments that are, mismanaged and typically have, maintenance issues. So, and a lot of these apartments are just owned. They're great apartments. They were just owned by elderly people, typically, who just got too old to manage or keep up. And, it's cash flowing. The money's there. It's in great opportunity markets. We just need to come in and love it back to life. And so that's that part. So the underwriting has to fit. It has to cash flow year after year. We do underwrite for a 5-year hold, and that's kind of it. And then we share that underwriting with our investors. And we kind of get a little bit of a feel. Does this look like something that you would be interested in? Then we call our management team and we actually do a site visit. So we'll actually comb through every door of that apartment complex. And we're looking at AC units. We're looking at roofs. We're looking at electrical. What are the upgrades? What, we call them value add. What's the value add? What can we do to be able to increase rents and, profit? And then, so if that works, then we we gather our money and we purchase.
And we have a question from Jeanette Jackson, which is, how do you find a good broker?
Call, just call. So we have a cred kit. So it's got, about, the kind of about us little catalog, what we've invested in, what our vision is about our business. And, you just call and you say, hey, here's my cred kit. I'm a closer. I'm, the end buyer. This is my track record. I come with a, phenomenal team. And you just, make relationships, find out what they like, find little details about them. Like, do they have a dog? Like, send them dog treats. Or do they have kids? Like, send them something at Christmas. Do you know when their birthday is? Send them a birthday card. Or if it's just something, brand new relationship, just keep in contact. Another thing that we do, especially when we have new brokers and they send us crap deals, because they will, I always give my feedback. Like, this is like very specifically why this deal didn't work for us or why it won't work for us. So they know we underwrote it and they know that we're paying attention. They're not just giving us stuff and, it sits in our inbox. Like, we really are working it. And then again, I just try to probe them like, hey, it's baseball season, like, who you rooting for? And they might say, well, I don't like baseball. I like golf. Okay, cool. I know they like golf. So maybe if I come across, a golf towel or something, I'm just going to send that to them and be like, hey, thought about you. And it's just little things, to just love on them and remain present. You want to, be front and center in their minds. So it's just cultivating relationships, which is really the whole gist of really everything in our lives. But, in real estate investing, it's like just cultivating relationships.
And it really just comes naturally when you find your people. You're not forcing it. It's just something that naturally you'll gravitate towards the ones that you want to work with. So
I'd like to actually, Rita and Jeanette, thank you for your questions. I'd like to a follow up to that in doing an analog back to single family. Of course, this is all pre-COVID, what I'm about to talk about. So no masks, and we were still meeting in public, in person, and having happy hours and whatnot. But where networking is key. Where all things being equal, I'm going to ask this in two ways: pre-COVID and post-COVID. Where would brokers hang out? Do they go to RIA meetings? Do they go to luncheons? Or where would you find them physically? And then now in a post-COVID world, how would you find them? Where are they hanging out, so to speak, in the digital
right
age?
So pre-COVID, and so this is saying too, like, I haven't worked with, so I live in San Antonio, Texas, for anybody that doesn't know. And I do very little business in San Antonio, Texas. Like, we've pretty much liquidated all our single family. We have a couple stragglers, owner finance, but I really don't do business in San Antonio. And so the brokers that I found were kind of like word of mouth. They were kind of given to me by other people that knew we were in the business in other states, but they're not really hanging out at the RIAs. They're hanging out at the business mastermind thing where they only let one person in. What is that? I don't know, but higher networking events, like ones that actually cost money, ones that they're actually going to get value out of. They're kind of hanging out at the country clubs. Oh, did I say that out loud?
No. I'm gonna take a stab at Landon Rothstein and free pizza and sandwiches.
Okay, right. Like,
but anyway, I have to poke fun at Landon. But
the inner circle cheesy bullshit.
Higher,
like,
right. That's okay. My kids aren't here. You can curse. It's fine. I don't
mean
mind.
to say that.
Watch out for the algorithm.
We all know the cheesy Rias. Like, I don't even bother. Like, every now and then I'll pop in when I'm super bored and my hair's fixed and my makeup, and I don't have to make any effort. But for the most part, they're so useless. Like, if you want to hang out, if like you have friends there, and we have friends that go to the Rias. If I want to hang out with them, I'm just going to call them and be like, let's just hang out. Like, I don't want to hear, the show and pony that you're going to put on that I don't care about. Like, I know everything you're going to teach up there anyway. I just want to hang out with my friends. Right. So I'm just going to go hang out with my friends somewhere cooler. But back to the brokers. A lot of it is just phone calls because they're not going to be in your state. Like what you need to do, or what anybody needs to do, what we did is we identified 3 or 4 markets that we really wanted to be in. Like where do we want to visit? Where do we want our apartment complexes? Where is it profitable? Where are people moving? So we kind of did like, some demographics on where we wanted to be. And then we picked up the phone and we actually called brokers in that area. We sent them our crud kit. We introduced ourselves and we just got on their lists and eventually, made connections with them, sent them cards, sent them emails. If I haven't heard from them in a couple weeks, I'll shoot them an email or I'll call them and say, hey, is the market slowing down? Like what's going on? And, and I talk about, I listen, talk about the things that they want to talk about, or, things that I know that I've gotten where I'm interested in them. But if, it's mostly by phone. The broker that I have, like he's actually in the town where my best friend lives. So we hang out a lot, but he's at the winery, right? He's at, gosh, I wish I could think of that networking thing. It's just super inclusive. They only let one, BNI, like they're at the BNIs.
BNI club.
Right? Yes.
Okay.
They're like, where are the clubs where like the truly wealthy hang out? That's where they are. They're at the golf course. Like he's always at the golf course, bourbon tastings, like cigar clubs. Like that's where your good brokers are.
While we're on this subject again, Jeanette also asked another question. She said, how does a beginner get access to those higher events?
To the buyer list?
No, to the events, those higher ticket events where the brokers are hanging out.
You show up. I mean, some of them cost. So I know the BNI, it's industry exclusive. So if there's like another broker, like another real estate investor, like you're not getting in, right? But if I'm the only real estate investor, I'm going to get in. And I can, rest assured that I'm not competing with anybody. And I know BNI really preaches like to do business amongst each other. So that's really nice. But like the country clubs, like just get a membership. The wineries, you just go hang out. But as you get to know these people and make those relationships, they're going to tell you where they are, right? They're going to say, hey, I'm at the car club this weekend. And then you just like magically appear, and I invite my brokers too, to other events that I go to. There are a small handful of events that I will attend, because they're worth it. And, like the hero event that we were at, like I would invite my brokers to that, and bring them on, this is what I do. And these are who I work with. And, so don't be afraid to invite them out, take them to Perry's, take them to the winery, and, that's kind of it. But, sometimes when they're in another state, that's a little harder. So you just, but I travel extensively. And so it's sometimes nothing for me to go to another state where I have a broker and I'm like, hey, I'm in town, let's get together.
Yeah. And I was going to add to that, racket clubs, country clubs, social clubs that have a high barrier to entry, or high cost, I've found, in all aspects of business that I've handled, interesting places to go to find something like a broker. The BNI, I've visited several times. I've flirted with joining, but like to your point, if there's a real estate broker, there's only one. If there's a roofer, there's only one. It's very selective in each group, and they do suggest that you do business and bring leads to everybody else. But also, some of the events I've found the big mega, the big gun show of RIAs that come to town every now and again, that cost $30 or $50 just to get in. I've actually found some very interesting connections there, finding folks, but you have to be extremely proactive. You just can't sit back and wait for people to come and talk to you. You got to engage them. And if introverts, get drunk, do whatever you got to do to get over it, and just start talking to people, because that's how networks expand. Oh, I'm sorry, what was that, Lauren?
Just call me, I'll shoot.
Yes. Yeah. To Lauren's credit, introverts, if you are introverted and you cannot do these things, find an extrovert and just be their wingman, right? So
Yeah, take
And
notes.
then, yeah, by association, you just became an extrovert.
There you go.
Absolutely. So, all right. So let's. Do you use a similar approach to, say, for example? Well, first off, let me. I feel like we should back up a little bit. Um, you can get a single family appraised. You can get an apartment appraised. All right. There's the single family appraisal usually is a replacement cost or a comparable sale. Right. What are the comps in the area? Looking at multifamily. There is a price if something happened and you had to rebuild. However, how much is cash flow looked at in that appraisal of that advice? So if we're looking for an ARV, right, you can get your realtor, go on MLS, look at the single family home, houses in the area are selling for 200, whatever. There's your ARV. Let's say you have a street with 3 different apartment complexes, different classes of, ABC or whatever. How is that ARV arrived at when you're underwriting? How do you determine that?
It's rents, occupancy and rents. So that's what we're looking at. We're looking at what is the occupancy, what are the rents, and how much below rents is it comparative to other. So we buy C-class properties. But we want to raise the rents and do the value add to make it a B class. So what are the rents for the other B class properties? And then what do we need to do to get there? So that's all in an underwriting spreadsheet. Exactly what that plan is. It's in a PPM. Like we know, like it needs roofs. We know like it needs interior work. We know that the parking lot needs paved. So all of that is part of our value add and our raise, and it's all in the underwriting and it's all in the PPM. So it's not really like single family where it's so cut and dry, like 70% of ARV minus repairs. It's not quite like that. But in the underwriting, there are formulas, and it's, you plug in the numbers and then it shoots out if it's going to cash flow or not. So I don't know if that really answered your question, but
not at all. But no, I'm kidding. No, I'm kidding. I'm kidding.
Yeah, that's one of the few. Like,
I want to unpack a little bit of it though. But
yeah.
what you said. So let's go back in. You said you buy C-class property. So let's real quickly A, B, C, D. Like what are the criteria or the levels of intervention for each class?
Right. Like, so A-class properties, those are like your penthouses, right? Those have like all the luxury amenities. Those are probably on top of a Starbucks or some sort of coffee shop, and they have a gym, and there's probably a doorman, right? So those are A-class properties. B-class properties are like working class properties. Like you and I would live in a B-class property. I would live in an A-class, but like 2 years ago I'd live in a B-class. They're nice, right?
Check your privilege, ma'am. I'm sorry, please. Okay, this is live.
Oh.
Sorry.
But rewind. I would totally live in a B-class property, right? Like, but really, I mean, they're safe, they're clean. If you have a job, you can live there. They're great for, people that, are transient, like they travel in their jobs. They're great for military families, they're great for couples that are just starting out. So they're like really just everybody, suburbia kind of apartments. C-class are just a step below that. Like, yeah, they're nice, they're okay. They might be in a little bit of sketchy area that's maybe gentrifying, and coming up. But like I said, they're probably just mismanaged and they have some work that needs to be done. So they might have some sketchy people in there that you don't want to live there anymore. That's something that we clean out. And so anyway, C-class, and then of course the D and F class is,
that's where I would live. So let's talk about
that is where
my
you
hovels.
would live. Yeah, but you can come visit my A-class property. Like I'll hose you off in the driveway and then I'll let you up.
Be deloused, and then I can come in like I'm going to prison. Okay, yeah, all right. I'm on board. I'm not scared.
The DF, those are like, you just can't help those, right? They're probably a tear down or, not. So anyway, C-class is like the perfect, the perfect criteria, because then we can do the value adds. We can clean them up. We can get rid of the tenants that are kind of running it down. We make it pretty. We make it safe. We make it where people want to live there. And what's great too about B class properties is when the economy is really good and people are getting raises and there's tons of jobs, the people that have lived in C class are moving up to the B class properties. So we're full all the time. And then when the economy tanks, all the A class people that can no longer afford their Starbucks and their Frappuccinos and their gym memberships, they're coming down and moving into the B class properties. So when the economy's good, we have full occupancy. And when the economy's bad, we still have full occupancy. So it's really just the sweet spot of apartment investing.
Interesting. Okay. Yeah. So I learned about the classes of commercial in an old W-2 when we were, looking for leases and moving, and, you'd be surprised that, there's a C class right next to an A class. And it's like, why, how's there, different, if you look from a neighborhood perspective, right, a business corridor or whatever, but the amenities and how much was leased out and what the cash flow was, not the age of the building, not the condition of the building so much. I mean, that factored into it, but so much of it was the economics of the building, which is an interesting concept to get your head around, but it makes sense. How much can that asset produce, right?
Yeah. And the
line.
other thing that I love about like the asset is that it appreciates and depreciates at the same time. So like all real estate, we're constantly, it's appreciating, but because it's a building and considered a commercial building, it's also depreciating. So you get to write that depreciation off on your taxes. So anybody out there that's complaining, I pay too much in taxes, get involved in multifamily. Get your K1 at the end of the year and use that to offset your taxes.
Yeah, that's a great. That's one thing I miss. I was a crappy landlord with single family. Like I was bad. That's why I'm a private lender. That's why I learned my lesson. I took my lumps, and moved on. But one thing I did miss was April 15th every year was being able to depreciate some of that asset off of my taxes, and my returns got big. Like, hey, this is nice. And when I sold those properties, all that went away, and you can't depreciate a note like you can an asset. So yeah, I do look forward to my K1s coming in so that I can participate in that depreciation, being able to take it off, depreciate it off of your taxes. The other thing you mentioned real quick, another acronym, just want to make sure the audience gets, is once you said you're done with your underwriting, you kick out the PPM. So let's talk about what the PPM stands for and what's in it.
Yeah, so it's the private placement memorandum, and it's basically 100-page book of everything that could go wrong with the property, who's involved, what the payouts are, and it's just basically, a 100-page book of what to expect, the good, the bad, the ugly. So, we're not allowed to say that it's super safe, but I don't understand how it's not. So, we only buy cash flowing apartments. If it burns down, it's heavily insured. So we're still getting our money. If a tornado rips it apart, again, it's heavily insured. We're still getting paid. We just cash out super early and roll that money over and buy something else. So, it's basically the book that says all of that, who are the investors, and what the payouts are, because everybody wants to know what they're getting, right? And so it actually in fine detail explains how that deal is divided out monetarily.
So I'm glad you brought that up, because I'm the reason I'm private lender is I'm very lazy, and I like passivity in my investments. I don't like having to work. I don't want to sweat for my money, if you know what I mean, right? I don't want to do it. So that's why I like lending, right? I can still control in a single family world, I still control the lien on a property. However, in multifamily, it's a little different, but it is, I don't have to run it. I don't have to worry about payments to the bank. I don't have to worry about tenants, toilets, termites, tornadoes, thieves of copper, less than
Yeah.
savory folks around. So it is very passive. So what's the difference between like your group, Vorsa would come in, purchase it, operate it, establish the management and the operations, whereas someone like me, I just come in, I'm very passive. What's that distinction in between? Coming from a single family, I get a lien. However, I would be buying into an entity at this point. Is that I understand that correctly?
So you're basically you own real estate without being a landlord, and we give people that opportunity. So you actually have ownership in that building. You can go there, you can touch it, you can ask for financials, which they get every month anyway. But you could actually drive there, meet the staff, touch the building, and know that you own a piece of that. But you don't have any of the stressors, like you just said. It's literally mailbox money. So I'm at the beach right now. You see the boat and the lights, and that's kind of how I live. I live, on mailbox money. I know that every quarter. So our deals, they are accrued monthly but paid quarterly. So I know every quarter I'm going to get a pretty fat chunk of change, and I'm going to get that every quarter until we cash out, and then the back end payout is X amount of $1 million, so, it's a long play. And that's what a lot of single family people, I don't think get, or nor are they interested in it. Cause they're like, well, I could do 50 houses in a year. And, I'm in and out, in and out, in and out, where this is like a long-term play. So, if you put up $1 million, your $1 million is, it's locked up until 3 to 5 years when we cash out, but it's going to be a super fat cash out, not to mention the, passive consistent income that you get quarterly for 5 years.
So that's is it a guarantee that in 3 to 5 years you'll cash out, or do you refinance?
I don't guarantee anything. There is no guarantee ever, and I would never guarantee anything. So here's the thing. Like right now, it is a seller's market, and people are buying like crazy. So there are a lot of assets that we've had where we thought we were going to hold 5 years, but we went ahead and cashed them out now, because why not? Like, we are making in year 3 what we would have made in year 5. So let's just cash out while it's good, because who knows what's going to happen in 2 years, right? So 5 years is kind of like our sweet spot. But let's say year 5, the economy has completely tanked and it just does not behoove us. We're going to lose money if we sell. Well, let's hold on to it another year or two. People are still getting paid, right? You're still getting your quarterly checks. We're just going to extend it a year or two. So when the economy comes back up, now we're back in a seller's market, we get that sweet spot. So again, another beautiful thing about it is, again, when the economy's bad, and this is all real estate, not just multifamily, you hold real estate long enough, it's going to cash out.
Yeah. Yeah. When I first got into some of this, one of the first PPMs I looked at said this was going to be a long-term hold. It was 5 years, but the plan was to refinance at 5, cash out. Anybody who wants their cash can get it, and anybody who wants to, level up and get some more equity, they would have that opportunity. But there's this huge caveat, and the operator said, "Look, anytime I buy a building, doesn't matter if it's multifamily, commercial, whatever." He goes, "I have a price in my head, and I put it down on paper. If somebody is, pardon the French, dumb enough to offer and execute that price, then the building is always for sale for that price, at that high level." And because I was there's one is a historical piece of property, historical to me, I guess, or I guess that's more was that sentimental here in Houston. But I was like, I want to pass this down to my kids. I don't want to let my ownership go and cash out. I would want to pass it on in a legacy. And he said, "Well, that's the plan. However, if somebody comes along and says, yeah, I'll cut a check for that," and they can produce that check and it clears, boom, those profits are taken, and you move on to the next deal. So, which is something I've never known, with the single family. I know people have a price, but going in with that mentality ahead of time, I think was a new wrinkle for me. Because like you said, it's cyclical. You hold on to it long enough, it'll. It will pay you out. So okay, so the private placement memorandum, that's your blueprint. That's your book of what you want to.
Go ahead, Lauren.
Yeah, I'm sorry. Go ahead, Lauren.
Yeah, I just wanted to also just make a little side note about the stock market and the volatility. And a lot of people are having quite a bit of uncertainty with that, with like just getting any kind of return. So it's another way to not have to invest your money in such a chaotic route, I suppose. So
Yeah.
Right. Which, you know, kind of reminds me like the people that think, well, I could never invest in that. You know, how many people do you know that have an old 401k or IRA that's just hanging there? Like it's just sitting there. Like, why would you not make, you know, a higher than average interest rate? Pull that out and invest that. You know, people think, well, I don't have that kind of money in the bank. Well, you probably do and don't even realize it.
Well, I was going to say, so my, so let me just backtrack. My parents were born before the Second World War, so they're technically not even baby boomers, but they came from that that mentality of I'm going to go put my money in a 3 or 5 year what do you call it CD at the bank.
CD
You
at
know,
2%.
not even now. Yeah, I mean, like it's like why you can go get a preferred 7 or 8, right, and then be able to
Right.
capitalize on the back end. So I think a lot of people forget about those. They think if it's not conservative or it's not safe. But look,
Even a savings account, like if you have money in a savings, why would you not invest that? You know,
right,
why are you okay with 1%? Why are you okay with 2%? You know, which boggles my mind why people are okay with um financial advisors who are taking a cut of their they're making money off your money and you don't know where your money is even at or what it's funding. And and they're like, oh, but my financial advisor, well, yeah, your financial advisor is getting rich off of you. And, of course they don't want you to pull the money out. So it's just boggles my mind. Like, okay, well, have fun losing your money when the stock market tanks. And then, maybe then you'll rethink things and invest with me. Because when the stock market tanks, we're still making money,
yeah. Well,
but that's not a guarantee.
I
I'm just saying.
saw. Yeah. Well, that's look. No investment's 100%, right? That's just
Uh-uh.
the way. That's the way life is. But no, the reason these are my hashtags: my money, my terms, never trust, always verify, and those came out of my experience with my family's financial advisor, who oddly enough got both my parents and my grandmother into a limited partnership that was supposed to last 7 years. And it involved. Airplanes and leasing them back out. And after 7 years, they couldn't sell the planes. And so I think it was like 5 years. But anyway, 10 years later, they're still trying to liquidate these airplanes and whatnot. And that was when I decided that even if I do have somebody handling my finances, that I'm going to take it upon myself to be extremely active and know what's going on. And yeah, it's a bit of a hassle. It's not so passive, but at the same time, like if I lose my money, shame on me, right? But if someone else loses, I trust somebody that I know is going to get huge commissions on whatever they put me in. And just by the way, I'm sorry. How is it that Schwab and all these places now there's no commissions? There are no commissions on any transactions, and yet they're still making their money, right? To me, how? Okay, if you're not directly charging me for my transactions, I get that per transaction fee. Realtors, they're going to get each side gets 3% in a transaction. I get that, right? Stockbroker, I was Scott Trade or Ameritrade, TD Ameritrade now or Fidelity, right? Everyone's dropping their commissions, but yet they're still making money, but they're not charging us, and this is all legal.
Right.
I don't have an answer. I just realized that I just opened a can of worms and I'm gonna have to throw it away because I don't know what I'm going to do with it. But it's just one of those thoughts that it hit my head.
Ask your financial advisor. If you have a financial advisor, ask them if the stock market tanks and you lose all your money, will they sell their house or their cars or their jewelry or their vacation rentals to make you whole? Ask them that and see if they don't laugh in your face or, like give you that look like, but ask me
Absolutely,
if
absolutely, I will.
if I could not cash flow, if I would not sell my house, if I wouldn't sell my prized Jeep, like my Jeep convertible I love with all my heart, ask me if I wouldn't sell that to make sure you were whole, but that's a whole other thing. Like if you trust your financial advisor, shame on you.
Yeah, and there's some good ones. Don't get me wrong. I have some friends that are trust their advisors implicitly, and especially the last 2 years, they're, I know a couple of retirements that have been moved up just because of COVID and the wackiness that stock market has seen. And, there were some astute advisors that said, hey, we're going to yank it out here, right? And we're going to wait. Oh, let's put it back in now. And, my friend's removed from, he's gone from 61 now to, I think he's going to 56. He'll be able to, he's added like 5 years. He can shave off.
That's really nice, but he better pull out in time. If he doesn't, it's all gone. It's
phrasing.
gone.
But yeah, no, that's absolutely right.
It's so up and down, and people live on that, live for that, right? Like they love that volatility. I don't want my family to, I don't want my friends to. I want the smooth, passive, consistent income. Like every month or every quarter, you're getting the same check. You're getting the same check. You're getting the same check. And it's not up or down. It's not win or lose. It's just smooth the whole time. Just a smooth racetrack.
I think it was George Soros who said, good investing is boring, like watching paint dry.
Yeah.
You take out the highs and and the lows and everything. You just straight and steady. But
he's got that money to lose. Like a lot of us don't. A lot of us don't. Sometimes that $100,000 is all the money in the world we have, and when it's gone, it's gone.
Yep.
Our retirement is gone. College funds are gone. It's just you can't get that back.
So
you're just in business. So that's why I'm going to harp again on the winning team. Make sure you find your people. Make sure you're doing the right thing. You're doing your due diligence. That wherever you do invest, it's with someone that will return what they promise, and you'll be able to sleep beautifully at night. So
that's so finding brokers, finding a team, underwriting, vetting deal. What do you find is the biggest challenge as a multifamily investor for you?
The funding, absolutely the funding, and building that funding funnel. And what that means is, we don't pay for these apartments out of our pockets, right? So we have to syndicate that money. We have to bring that money in. We have to bring in investors to chip in and purchase these apartments. And so, building that funnel is definitely the biggest challenge.
Finding private lenders to bring money to the table and to buy into the deal.
Yeah.
Has COVID made that more difficult for you?
Absolutely. And the administration change, again, not to get political, but where a lot of people were very confident in our economy, and they were confident, that we were going to continue to grow and scale. Like that confidence just vanished. I mean, it was just, overnight, just gone. And people are very reluctant to put their money in, an economy that they don't know what's going to happen.
Yeah, well, that's we'll wait 4 years. It might change again. Who knows?
Hopefully.
Yeah, right. I mean, that's why the old joke people ask me, are you Republican or Democrat? I said, I'm a bleeding heart libertarian entrepreneur.
Yes.
I don't care who's in office, but I have to play by the rules, right? Like, because there's going to be a change, right? There's quite often changes. And I guess the most recent change outside of, administrations was, Dodd-Frank coming in and really shaking up the world back after 2008 and the big crisis, and how mortgages and everything else, now owner finance you got to get everything originated properly, and that's not a complaint. It's just, those are the rules. They're in place to help the consumer. I understand. And I'm not against helping the consumer, but to your point, when you have, wildly differing administrations coming in, after alternating each other, I could imagine it would get a little difficult. So what is let me ask you this: your typical investor who sort of what's their demographic? Are they millennials? I doubt it, but like where are they? So where are they? What walk of life,
busy.
job?
Yeah, they're busy professionals that want to own real estate without being landlords. They want to retire early. They were burned in 2008. They want out of the volatile stock market. They want smooth, passive, consistent income that they know every quarter they're going to get a check, and they're just probably going to, sock it away. And, and they just want, they want an easy, they want easy returns. They don't want to be bothered. They just want their check every quarter and they want their back end payout, and they just want to recycle that until they're able to, retire, till they are, what their idea of wealthy is. And we help them get there.
And so, and correct me if my understanding is, so someone like me, a passive investor, would come in. Whatever, look at the merits of the deal, look at the minimum buy-in, whatever. So my group, we would be the limited partners, right, in a syndication. Like we would be behind the LP, and essentially we provide the down payment, and then a financial institution like a bank would come in with the rest of the money, or let's say the seller wants to carry a seller owner finance note back or whatever. So that is the mechanics of what happens. As your passive investors put the down payment down, the bank is on for the rest of it. Is it still sort of that 70% LTV, 20%, or I'm sorry, 80%, or did we lose Jen?
No, I'm running out of battery.
Okay. All right. Well, if that's the case, we'll just quickly answer that. Then, what was I don't even remember my question.
Yeah, right.
The LTV.
So every deal is different. Like, are
percentages.
you asking how it's structured?
Yeah.
Okay, so every deal is different. And it really depends on what kind of returns can that deal hold, right? So if I only have one investor that's coming in with all the money, like, I'm going to give them a really large chunk of the pie, right? Or if they're coming in and they're bringing in 2 people with them, like, so it kind of really goes on how many people are coming in. Like, are 10 people coming in? That gives us smaller chunks of the pie.
Sure.
So it might just be, typical. A 6 and 6 or an 8 and 8. So, everybody that comes in just gets a straight 6% residual, and 6% on the back end, or 8% on the back end. Sometimes it is a 70-30 split. If somebody came in, I needed $3 million, and one person came in and said, hey, I'll put in the whole thing, I'd give them, 50% of the, of the pie, so it really is very dependent on how many people are coming in, and what do the returns look like. So we want everybody to be wowed. We want to give them a good rate of return. And so we know that kind of going in, and we kind of know before we start to talk to anybody how that's going to be structured, and see if we get any pushback, if it's somebody, it's all negotiable, right? But once the PPM is written, that's it. Like, it's stuck. Like, the PPM is like the final word. So we definitely want all of this hatched out, make sure everybody's happy before we commit to the PPM.
I would like to go further with this. Your battery's running out. Why don't we do this? Why don't we reconvene Thursday, 7:30, and why don't you walk us through a syndication?
Absolutely.
What it looks like, why the SEC cares, how you stay compliant, how, what do I need to do anything outside of, proving, to prove my accreditation, et cetera, et cetera. I think if we could do a little cliffhanger tease here, stay tuned for Thursday's episode. But yeah, I would definitely like to go through that, or have you guys go through that and sort of walk the audience through it, because it's very fascinating. This is, a lot of folks, we start off in single family, we make our moves, and I'm sort of looking out there now, like, I've done owner finance, I'm a shitty landlord, where am I going to go next, kind of thing. But I do like
side.
but I to your point though, I guess the merits of the deal, the payoff of the deal would depend on how many K1s you have to produce every year. So the fewer the K1s, the better it is for the private lender coming in with the cash. Like I said, if I could give you $3 million on one deal, then I'm going to get a bigger cut than if there's 100 of us,
Sure.
all divvied up across that $3 million. So that makes sense. Well, Jen, Lauren, thank you guys for coming on so much. And Jen, if you wouldn't mind, can I see your glass? How much is left?
Oh, this was my 5th glass. So what you didn't see is the waitress coming back. So no, I'm just kidding. It's my first. Look, I barely took any drinks. That's why I got to go, because it's getting watered down.
All right, yeah, I'm a little jealous, but hey, well, thank you guys, and thank you everybody for the questions again. Rita and Jeanette,
Yes, thank you.
Asking away. Thank you so much. Again, you can where can they find you? Give your website.
www.vorsainvestments.com. VORSA investments plural.com.
And I
All
put
right.
a comment section too, just in case.
Oh, okay, you put it in the comment. Okay, cool. And
Yeah.
then
And put your muse, your subconscious muse on there too, please, Lauren.
yes, absolutely. Yeah, please.
And so
please
on my website, since we're going to be talking about syndications next time, there is a free book on there about how to vet a syndication. So if you think you're going to jump in on Thursday with questions, you can read that first and then, shoot the questions.
Oh yeah, let's shoot that out on Facebook and post that so that folks can see that and have it, ready to go. Cool.
Awesome.
All right.
All right, my loves. Thank you so
Very
much.
much. All right. We'll see everybody on Thursday.